Okay, welcome back, everybody. Today we're going to be covering Chapter 5. It deals with activity based costing and management. The learning objectives for this chapter are going to be to explain why functional or volume based costing approaches may produce distorted costs, explain how an activity based costing system works for product costing, and describe activity based customer costing and activity based supplier costing. And then lastly, explain how activity-based management can be used for cost reduction. Okay, first let's start off by talking about the limitations of functional-based cost accounting systems. So plant-wide and departmental rate-based on direct labor hours, machine hours, or other volume-based measures have been used for decades to assign these overhead costs that are used for the products and to continue to be used successfully by many organizations, even to this day. Unfortunately, for many settings, this approach to costing is going to be equivalent to an averaging approach, and a lot. So with it just being an average, there could be a lot of distortions and a lot of inaccurate cost by doing things this way. So we can see here that this issue right here with the plant-wide and departmental rates that they're talking about on this slide here is what's leading to these activity-based costing for a more accurate measure. Product cost distortions can be damaging, particularly for the firms whose business environment is going to be characterized by any of the following characteristics down here. The first one being continuous improvement. Second one, small profit margins, increasing competitive pressures, total quality management, total customer satisfaction, sophisticated technology, and intense worldwide competition. So we could see why firms with these in particular types of characteristics would have problems when it comes to the product cost distortions, especially with companies with small profit margins. So if your profit margin is already very small to begin with, then obviously if you have some cost distortions, then that could really affect your overall profit margin, which has an overall effect on the rest of your earnings. So we could see how all of these could play a role in having a direct correlation to the cost distortions here. The need for more accurate product cost has forced many companies to take a serious look at their costing procedures. Two of the major factors that are going to impair the ability of a unit-based plant-wide and departmental rates to assign overhead cost accurately consist of the last two bullet points right here on this slide. The first one being the proportion of non-unit related overhead costs being tied to the total overhead cost being large. The degree of product diversity is going to be great. So once again, these are going to be the two major factors that are going to impair the ability of a unit-based plant-wide or departmental rates, okay, to be able to use those to assign this overhead cost accurately. Once again, the product diversity, if that's great, that's gonna be an issue. And once again, the proportion of non-unit related overhead costs to the total overhead costs being large. Okay, non-unit related overhead costs. This is where the use of either plant-wide rates or departmental rates are going to assume that a product's consumption of overhead resources is going to be related strictly to only the units produced. So for example, every unit level of activities, this assumption makes sense, right? Right. So what we mean by for every level, right here it says activities are performed each time a unit is produced. Okay. If there are non-unit level activities or activities that are not performed each time a unit of product is being produced, then the costs associated with these non-unit level activities are going to be unlikely to vary. So that means they're going to be more unlikely to either increase or decrease with the units that are being produced. This slide here just shows a little bit about categorizing costs under ABC, which is activity-based costing. Once again, so anytime we see ABC moving forward, that's activity-based costing. So on the left side of this chart, we can see we have the type of cost here. Then in the middle, we have the description of the cost driver. And then on the end here, we have the example. So First, we'll start with the unit level one. We can see on the type of cost being the unit level, then obviously the description of the cost driver is going to be that it varies with the output volume. So meaning if the more units of something you produce, then that unit level, that cost driver is going to change. That's an example of a traditional variable cost right here on the unit level here. Another example would be the cost of indirect materials for labeling each bottle of Victoria's Secret's perfume. So we know that right there is going to be a variable cost to the company. For obviously, more bottles of perfume produced, the more labels they're going to have. The batch level type of cost, this varies with the number of batches that are being produced. An example of that is the cost of setting up laser engraving equipment for each batch of epilogue keychains. Next type of cost being the product sustaining cost. This is going to vary with the number of product lines that are out there within the company. Good example here is the cost of inventory handling and warranty servicing of different brands carried by Best Buy Electronics. Facility sustaining, this type of cost, that the relevant cost driver would be whatever is necessary to operate the plant facility, but does not necessarily vary with the units that are the batches that are being produced, or even within the product lines as well. A good example here would be like General Motors plant manager's salary. Then obviously we know that's going to vary usually based upon production, so that's going to be different than any of the other factors that were mentioned previously. Okay, activity drivers and the consumption of activities. So first one here, the non-unit level activity drivers. These are going to be the factors that measure the consumption of the non-unit level activities by products and other cost objects. Okay, so once again, these are going to be batch, product sustaining, and facility sustaining. Next, the unit level activity drivers. These are going to measure the consumption of unit level activities. And then lastly, the activity drivers. The activity drivers are going to be the factors that actually measure the consumption of these activities by the products and other cost objects, and can ultimately be classified as either a unit level or a non-unit level. So once again, these activity drivers are going to have effect with both the unit level activity drivers and the non-unit level activity drivers here. So both ones previously mentioned have some type of a relationship with this activity driver here. Okay, let's talk a little bit about distorted product costs. So using only unit-based activity drivers to assign the non-unit related overhead cost can create a distorted product cost. So the severity of this distortion is going to ultimately depend on what proportion of total overhead cost that these units are going to be based on the cost that they represent. If the non-unit based overhead costs are only a small percentage of total overhead costs, then the distortion of the product cost will be quite small. And if this is the case where it's not a material amount, as just mentioned here, then using the unit-based activity driver is going to be an acceptable method under these circumstances here. So once again, if it's a small or a non-material amount, we're talking about the distortion of those product costs. If that's the case, then that's fine to use this method. We don't have to use another method. Okay, let's talk a little bit about product diversity. So the presence of product diversity is also necessary for product cost distortion. Product diversity is meaning that the products consume overhead activities in systematically different proportions. So this may occur for several reasons. We can see here there's a list of reasons here. Product size. So obviously the size of a product could obviously have an effect on how that product's produced. The product complexity. So the product complexity could have a direct correlation with the setup time, or same with the product size. So you can see how they could be interrelated. But these are going to be the main differences we would expect to see within product diversity. Setup time, and size of batches. So we could see how that would make sense. Okay, how it's used in your life. I'm not going to run through these. You can read through this on your own time. There's 7 slides here. Okay, consumption ratio. So regardless of the nature of the product diversity, these product costs will be distorted whenever the quantity of unit-based overhead that a product consumes does not vary in direct proportion to the quantity consumed of the non-unit based overhead. So the cost of these shared resources obviously need to be assigned in proportion to the amount of the resources in which they're consumed for each product. So pretty much that's all they're talking about here is um, every product's different as far as what resources it takes to make these products, meaning the time, the direct materials, the labor, whatever it might be. So we just want to try to trace exactly how much of each one of those materials or hours or whatever it might be relate to each activity or each party or department or each individual product. That's all it's saying, that we just want to trace it to each one instead of just doing an average. Since activities represent bundles of resources consumed by products, it's reasonable to assign activity cost in proportion to the amount of activity consumed. So once again, it's just telling us again that we need to allocate it accordingly to the weight. Okay, more on the consumption ratio. We can see here the actual ratio is the amount of activity driver per product divided by the total driver quantity. So once again, this means that the activity drivers are going to measure the activity output, and then in turn that can be used as a measure of the activity consumption. So obviously the proportion of each activity consumed by each individual product is going to be defined as the consumption ratio. So once again, the way that you calculate the consumption ratio, the formula itself is the amount of activity driver per product as your numerator, and your denominator is the total driver quantity. Okay, so let's go ahead and apply that formula now. So how to calculate consumption ratios. So Exhibit 5.2, product costing data for Rio Novo's Porto Belo plant. So we can see here we have two different types of activity usage measures. One's for a deluxe product, one's for a regular product. We can see here on the right hand side, this is going to be the total, so the sum of these two columns. We can see moving from left to right, 10 and 100 is 110, 800 and 8,000 is 8,800, and so on and so forth. On the left-hand column here, we have the different type of items, the units produced, your prime costs, direct labor hours, so on and so forth. Down here, we have the activity cost data activity. So these are the overhead activities. So this is the actual activity right here. So this setting up equipment, moving goods, machining, assembly, and then the total down here at the bottom. And this is the activity cost data. So the activity cost for each one of these relative items here. So for example, setting up equipment was $1,000, moving goods was $1,000, and so on and so forth. Okay, so let's refer to the activity uses information. So the two charts here that we just looked at for the Rio Novo's plant, and what they want us to do is calculate the consumption ratios for each one of these products. Okay, so let's look at the solution here of how we can see this is going to be accomplished. The first step says they want us to identify the activity driver for each activity. Okay, so we can see here on this step here the overhead activity: setting up equipment, moving goods, machining, and assembly. Okay, so we can see here that that's the overhead activity, but the thing that's related to it, meaning the activity driver, is going to be obviously for setting up the equipment. That's going to be your setup hours. Okay, moving goods, that's going to be the number of moves, will be your activity driver. Machining, that's going to be machine hours. Assembly, direct labor hours. Okay, so that's the relationship between the overhead activity and the activity driver. So now in the middle here, you can see we have these consumption ratios, one for the deluxe model and one for the regular model. Okay, and these are the actual percentages or the ratios that we would be applying to each one of these models. Now the way that we found that, you can see here the little label here, A, B, C, and D. You can see down here it's going to give us the formula. So the way they got, obviously 3/4 and 1/4 is 0.75, 0.25. So that's that, right? Well, the way that we got the data was based upon, hold on just a second, setting up equipment, setup hours. So we can see setting up equipment was 1,000. Okay, setup hours was a total of 4. So we're measuring the setting up of equipment, remember, because there's the direct relation, setting up equipment, and the activity driver was the setup hours. So setting up equipment was $1,000, right? But now we want the ratio of what the actual setup hours were. So we can see here for deluxe, that was 3. Total hours was 4. For 3 of those hours was used for the deluxe option, and only 1 was for the regular. So 3 out of 4 gives you your 0.75 here, so 3/4, and then the 1/4 or 0.25 for the regular is going to come from the other one, the 1 hour out of the 4. So that's where these numbers down here are coming from. So once again, let's look at the moving goods. That's the overhead activity. The activity driver for the moving goods is going to be the number of moves here. We can see here for the deluxe, it's a 0.6. So let's go ahead and look back up here. So the number of moves, so 0.6, that we get, that's 60%. So we can see that here, that's 6 out of 10. So there's where your 0.6 comes from. The next one for the regular, that's going to be the 4/10 or 0.4. So we can go back down here and see the 0.4 or the 4/10. Okay, and same thing goes for the machining and the assembly to get these ratios here. You just go back to the chart here and just see what it is, machine hours. So that's 10 out of 5, so that's going to be 0.2, and 10 out of 5, right, so 0.2, and so on and so forth. So you get the gist of how we go about calculating the consumption ratios here. So that's where these ratios came from right here, based upon that data up here. And just remember, the main thing is to tie the overhead activity with the activity driver. Okay, solving the problem of cost distortion. So cost distortion can be solved using activity rates. So once again, activity rates can be used as a helpful means of trying to reduce or eliminate the cost distortion. Instead of assigning the overhead cost using a single plant-wide rate, a rate for each overhead activity should be used to calculate the assigned overhead costs. The activity rate is going to be the means by which activity costs are going to be assigned to the actual products. The rate for each activity is calculated by dividing the activity cost by an activity driver. So once again, how we were just looking at the other ones with the cost and the drivers, you can see that this trend continues throughout this lecture, that everything's tying back to this activity driver. A cause and effect relationship is going to be the basis for choosing the activity driver that's going to be used in the rate calculations, and then ultimately that's going to be divided by the units produced to yield the unit cost of each unit that's being produced. So once again, it's the cause and effect relationship, once again, what's tied to this activity driver. So once again, you can see here we have the activity and then the driver. So once again, the activity is going to be the setting up equipment, moving goods, machining, assembly. So we can see this is still the same thing that we built upon from the last one. The driver, the setup hours, all that, same thing. Setup hours, number of moves, machine hours, so on and so forth. Okay, and we remember the activity cost that we had. We had that from up here, right here, the 8,800, so on and so forth. Let's go back down here. Activity cost 1,000. There was 4 there. So let's see, for setup hours 4. Setup hours 4, number of moves, we can go back to that as well. Number of moves 10. So you can see where this data is coming from still. Activity cost, setting up equipment 1,000, moving goods 1,000. So we can see where the activity cost and the driver quantity is coming from still. So once again, just wanted to show you as you're studying this chapter where these numbers are coming from as you're working through these examples here. So once again, they want us to calculate the activity rates. Okay, So the solution, the way that we actually go about getting these activity rates is we just divide the activity cost by the total quality or the total driver quantity. Okay. So we can see here for the first one, the setup rate. Let's look at the setup rate. So that's obviously the setting up equipment, the cost of that activity, and then it's going to be divided by the setup hours, in this case 4. So we can see here there's the cost divided by the total driver quantity of 4. So obviously that's going to yield a setup hourly rate of $2.50 per hour. The materials handling rate, once again, we can see here that's the moving goods. So the handling of the goods, moving goods is the cost divided by the driver quantity of 10. Gives us $100 per move. All right, next, machining rate. See on machining, the cost divided by the hours, 1,500 divided by 50, $30 per machine hour. And then lastly, the assembly rate, 500 divided by 100. So once again, the activity cost, 500 divided by the driver quantity of 100. $5 per direct labor hour. So once again, this is how we calculate the activity rates, okay? Okay, so moving on more with solving the problem or the issue of cost distortion. So to increase the accuracy of overhead cost assignments, casual factors called activity drivers are going to be chosen to be the measure of the amount of activity that's consumed by a product. The activity rate multiplied by the amount used of each activity is going to determine the amount of activity cost that's assigned to a particular product. Now, the sum of all such assigned activity cost is the total amount of overhead consumed by a particular product. Overhead costs plus the prime cost divided by units produced are going to yield the actual unit cost. So once again, let's look at what we're talking about here. So how to calculate activity-based unit cost. So once again, that we're still talking about this Rio Novo's plant, activity cost and driver data. In this case, we can see here we have a deluxe and the regular that we're still talking about. And then we have the activity rate on the far right here. So we can see here the top line is the units produced per year. And we have 10 for deluxe, 100 for regular. The prime cost of 800 for deluxe and 8,000 for regular. And then here we can still see we pulled this data here on down from these other charts up here. Remember the setup hours, number of moves, machine hours, all these quantity drivers. So setup hours, number of moves, machine. So that's where this is coming from, 3, 1, all so on and so forth. Setup hours 4, but then the breakdown we had from up here. Remember the 3, 1. So this is what we're doing, machine hours. So this chart here, you can see starting with direct labor hours. This is what we're repeating down here. Same thing. Okay, and then we got the activity rate up here. When we found the rates, so that's where the rates are coming from. Remember, these are the activity rates, so 250, 100, 30, and 5. So that's where these are coming from. And remember, the data here is coming from the previous slide up here. Okay, so what's required for this problem on calculating the activity-based unit cost is going to be for both deluxe and regular models. We can see here, the best way to do that is to set up a little chart here. Give them 2 columns, one for each product, one being deluxe, one being regular. To start with the top, we'll just list our prime costs. We can see here the prime cost for each relative product here, 800 and 8,000 respectively. So we have 800 and 8,000 for your deluxe and your regular. Next, the setup hours. We're worrying about setup. Okay, so this is going to be dealing, remember this, the overhead cost that we're looking for now between the setups of the components that we have for that. So setups, let's look where we get this data from. Okay, setup hours, activity rate is $250. So that's where this 250 is coming from. Once again, that's your activity rate that we calculated up here. 250. So that's your 250 activity rate. Now we just want to multiply it by the amount of hours it takes for each product here. So we can see here the first one, setup hours is 3 to 1, so 3 for deluxe and 3 for regular. So we just want to multiply for each one. You can see here 3 for deluxe, 1 for regular. Okay, so obviously 250 times 1 is 250. Next, moving materials. We've got that number of moves. That's 100 is the activity rate. So we can see here, there's your activity rate. Once again, that's the 100 here, which is found right here. Materials handling activity rate. So once again, now the number of moves is based upon each number of moves for each product. Once again, 6 and 4 for deluxe and regular respectively. So activity driver by the number of moves. You can see here deluxe is 6 for 4 for regular. Then the same thing for machining. Take the activity rate that we found right here. There's your activity driver, right? Here's just your, pull this from the chart, your 10 and your 40. Apply them to each one. And then same thing for assembly. We can see here, direct labor hours. Go through there, 5, which we found here. There's your driver. And then just go about getting your amounts 20 and 80 once again right there. Now once you have those, obviously you can see here we just sum up each column for each product here. Then that'll give us our total manufacturing cost. I'm sorry. And then divide that by the units produced here. And that'll give us our unit cost for each the deluxe and regular products. The comparisons of functional and activity-based product costs, a plant-wide rate based on direct labor hours is going to be calculated as follows. So we can see here the formula for overhead. The numerator will be the total overhead costs. Your denominator is going to be the total direct labor hours. The activity-based cost assignment is going to reflect the pattern of overhead consumption and is going to be the most accurate. So once again, that'll be the most accurate measure. Activity-based product costing is going to reveal that functional-based costing, which is is going to ultimately undercost the low volume deluxe models and overcost the high volume regular models. Okay, now let's talk about a little bit about the product diversity and product costing accuracy. For unit level overhead rates to fail, then products must consume the non-unit level activities in proportions that are going to be significantly different than the unit level activities. Now, the key message of the relationship analysis is that in a diverse product environment, activity-based costing promises greater accuracy. Now, given the importance of making decisions based on accurate facts, now obviously we need to have a detailed look at activity-based costing to get a better actual shot of what's going on here. Okay, so let's look at product diversity and product costing accuracy on this chart right here, or on this line graph. So we can see here on the left we have the overhead cost of regular model. On the right, the average non-unit consumption ratio. You can see here the red line is the average non-unit consumption ratio right here, whereas the blue is going to be the overhead cost assignment with the plant-wide rate. So obviously we can see by looking at this analysis that as the average consumption ratio is going to decrease. So we can see here the average consumption ratio. So as it decreases, so obviously the lower the numbers be, then it's the farther down this line right here it's going to be. So as it decreases, then the difference between the activity based and the plant wide assignments increase. So the variance is going to increase as as this average non-unit consumption ratio is going to be smaller than your variance decreases between these two rates right here. Okay. So that's going to increase. The vertical lines are going to indicate the difference between the activity-based costing and the plant-wide rate overhead assignments. Now, obviously you can see by looking at this that some values can occur that would probably produce little difference between the plant-wide and the ABC assignments. We can see this here, and for this example here, it just happens to be around that 80% consumption ratio. for where there'd be a little difference. Not saying that's where it would be, but just for this visual right here and this line graph, that's what it's talking about here. So it'd be obviously cheaper and simpler to use a single rate costing system if that was the case. So right here, this just gives you a good little visual of how the variance can grow between the average non-unit consumption ratio and then that of the overhead cost assignment being used with the plant-wide rate instead. Okay, let's talk about activity-based product costing. So functional-based overhead cost involves two major stages. The first stage is going to be the overhead costs that are going to be assigned to an organizational unit. And by unit, I mean either a department or the plant, the overall plant itself. The second major stage is going to be the overhead costs being assigned to the cost objects themselves. So let's look at a little visual here of how it just flows down. So pretty much the underlying assumption is going to be that activities consume resources. So we know that any activity we do is going to consume some resources, with it being maybe raw material or whatever it's going to be, money, whatever it is. And cost objects in turn consume activities, right? Cost objects obviously being the customer or suppliers, whatever the territories, those consume activities, right? So in an activity based costing system, the emphasis is direct tracing, and the driver is tracing the volume based costing system. Okay, so we can see here the direct flow, the cost of the overhead being the indirect labor, the depreciation, the power, and so on and so forth. These have the driver tracing to the actual activity for the end result, which is ultimately the customer. So activity is anything done by people or equipment to be done ultimately for the customer or for other people. Identifying activities is usually accomplished by interviewing managers, so just through a group of questionnaires. So that's obviously the only way we can actually infer about those type of activities, is to talk to the people who are managing them and on the day-to-day operations, and also making decisions as to how those operations are going to be ran. So once again, we identify these activities through departmental interviews with various managers. Next couple slides just gives us an idea of what types of questions we would expect to see for trying to identify activities and the attributes that accompany those activities. The first set of key questions that you might expect to hear in these scenarios would be, how many employees are tied directly to your department? The reason why you'd be interested. What do they do? So describe what the activities that the people in these departments are actually doing, or what they're performing. Okay. So activities are going to be people doing things for other people. Recall that's what an activity is. So we want to know how many employees are in the department, because activities consume labor, and we also want to know what they do within their department. Some other questions. Do customers outside your department use any equipment? Activities also can be equipment working for other people. So pretty much the equipment provides the service for someone by itself. So we know a lot of times in these manufacturing companies, on the assembly line, there's not even any actual physical labor involved. So no humans are actually involved in certain steps throughout the process. So that's where you'd have an example of the actual machine providing the service on its own. Okay. What resources are used by each activity? So what resources we mean equipment, materials, energy, so on and so forth. And by each activities meaning whatever it might be, producing a piece of furniture or producing a liquid, whatever the activity is. Okay, because once again, activities consume the resources in addition to labor. What are the outputs of each activity? So why would we be concerned about the outputs of each activity? Remember, the outputs of the activity is going to be what we use as activity drivers, right? So that's going to help to identify our activity drivers based upon the outputs that these activities produce. Who or what uses the ultimate activity output. So this identifies your cost objects, meaning the products or customers or some other random activities even. How much time do workers spend on each activity? So obviously time is of the essence, and anything that you're doing. So time on each activity could be by time on equipment, time on a certain segment of that assembly line. So this information assigns the cost of labor and equipment to activities. And so we can see there's some good examples of some questions that you would ask these managers and these manufacturing companies when trying to pull data about these activity drivers and the work and labor and the materials that go into each of these activities. Now, after you use those questions and interview these managers, then you're going to take all that data and you're just going to put it into an activity dictionary. Okay, so this is once again just a summarization or a summary of the questions, like the answers to the questions that you ask these managers. Okay, so once again, this lists the activities in an organization along with some critical activity attributes. These attributes can be both financial and non-financial information. A lot of the examples you might expect to see in one of these activity dictionaries would be the activity name, measure of the activity output, so the activity driver, cost objects that consume the activity output. That would be maybe the reason for performing the activity, the amount of time spent on the activity by workers, and types of resources consumed. So you can see here they kind of relate to the questions that we ask those managers. This is just an example of an activity dictionary, and they're using this one for a credit card department. So you can see here on the first part here that we have the activity name on the left. We have activity description in the middle. We have the cost objects here on the second middle column. And then last on the right hand side column, we have the activity driver. So first thing here, the first activity would be the processing department. The activity description would be sorting, keying, and transactions verifying. The cost object would be tied to the credit cards. And then the driver would obviously be the number of transactions that they're processing. Preparing statements, this would be reviewing, printing, stuffing, and mailing as the description of that activity. This, once again, the cost object that's tied to the credit cards. And then obviously your activity driver here would be the number of statements. So you can get an idea of how this is flowing. I'm not going to read the last two examples here. If you're having a little bit of trouble understanding what you would expect to see in this activity dictionary, you can read through those. But pretty much that's what the gist of the activity dictionary is. Next, assigning costs to activities. So the next task is obviously to determine how much it costs to perform each activity. So this is why we need to assign these costs to these relative activities. So obviously labor, energy, materials, and capital. We can find all these expenses to the company within the general ledger. So they're going to be presented right there on the financial statements month to month to be able to base decisions off these amounts. But at the amount of time that's spent on each of these activities is not something that's just shown directly within the financial statements, outside of maybe being able to just look at just some of the direct labor based upon your wages that you pay to these direct labor sources. So for the shared resources, driver tracing is going to be used, and the drivers used to assign resources cost to activities are called resource drivers. These are going to be factors that measure the consumption of resources by activities. So what we mean by shared resources here, so if you use like a computer for different types of activities, and that's obviously going to be a shared resource, right? So if a printer is used for different activities, maybe for selling, marketing, maybe for purchasing and ordering, so that would be a shared resource, right? So let's look at this data here. So once again, this is assigning cost to activities. So a work distribution matrix is going to be developed. This is going to identify the amount of labor that's consumed by each activity. and it's derived from those interview questions that we just talked about earlier of what you would expect to to question at one of these departmental managers with. So that's where these questions would come from. This is obviously just an example, so this is made up data here. But once again, this data would come from those interviews from management with those relative questions. So right here we can see this little distribution matrix. On the left we have the activity. On the right we have the percentages of time for each relevant activity or each relative activity. First, we can see here we have the processing, transactions, preparing statements, answering questions. So this is the percentage of time spent on each one of these activities. Okay. So how to assign resource costs to activities by using the direct tracing and resource drivers. So we're going to use the work distribution matrix, for the Hemingway Bank's credit card statement that we just looked at up here. So with the breakdown of the percentage of time here and the activity for this example here. So let's assume that each clerk is going to be paid a salary of $30,000. Okay, so we have 5 clerks, so we're going to have a total of $150,000 in net salary. So once again, $30,000 for each clerk. So 5 clerks at $30,000 each is $150,000 for total clerical costs. Furthermore, each of these clerks has a computer. By looking in the general ledger, we can see that the cost per computer is going to be $1,200 per year. So once again, if there's $1,200 per computer per year, then that's going to be obviously $6,000 because there's 5 clerks, and remember each clerk has a computer, so that's going to be multiplied by 5 here. The computer time is 70% transaction processing, 20% statement preparation, and 10% answering questions. Okay, so based upon this data right here and the data right here and the work distribution matrix, what they want us to do is assign the cost of labor and the cost of computers to each of the activities and the credit department. They also want us to distinguish whether or not this assignment driver is tracing or that of a direct tracing. So let's look at the solution here. So the amount of labor and computer cost assigned to each activity is given below. So we can see here we have the activity. Remember the activities that we have were processing transactions, preparing statements, and answering questions. So once again, that's where this activity is coming from, is based upon this matrix right here. Okay, next we have labor costs, and then the following column we have computer costs, and then the last is the total, which is going to be the sum of the labor cost and the computer cost. So we can see here labor cost is $60,000, computer cost is $4,200 for a total of $64,200. Okay, so let's look at here with this processing transaction. So that's the activity. So for the labor cost, where did they get the $60,000? We can see here that they show us the way they got the 60,000 is 0.4 times 150, but where did these numbers come from? Where's the 0.4 and the 150 coming from? So let's back up here. So processing transactions, that's what we're working on, right? Processing transactions. Labor cost, 0.4. If you can see here in this work distribution matrix, the percentage of time per activity is going to be 40% for processing transactions. So that's your 0.4. The 150,000, remember we're working on labor cost here. That comes from 5 clerks at a salary of 30,000 each. So for 150,000 total clerical costs, there's your 150,000. So once again, 0.4 times 150,000 is 60,000. That's where this amount came from here. Next, for computer cost, remember we're dealing with processing transactions. Okay, with dealing with computer costs here. The computer time is 70% transaction processing. There's your 0.7, okay? And then once again, the $6,000, where did this cost come from? Remember, Each clerk has a computer. The GO revealed that the cost per computer is $1,200 per year. The 5 times 1,200 gives us 6,000. So there's the cost of the 5 computers. And once again, there's the percentage of time that it gave us for the transaction processing under the computers. So you can see where this amount came from, okay? Next, the preparing statements, 45,000 for labor costs. Remember the 0.3. Preparing statements, there's your 0.3. The 150, once again, 30,000 a year per clerk. There's 5 of them at 150. There's your 150. The computer cost, once again, preparing statements. The 0.2. 20% statement preparation. There's your 0.2. The 6,000. Remember, that's computer cost. 1,200 per year for per computer. Each clerk has a computer. There's 5 clerks. There's your 6,000, and so on and so forth. It'd be the same thing for answering questions. Okay. So labor and computers are both shared resources, and their costs are assigned using a resource driver. Okay. So the last part of that, this would be driver tracing, right? So it's a resource driver because they're shared. The labor cost to computer cost, we have to drive wherever with the percentages that we did right here based upon that matrix here and the data given to us in this question. Okay, let's talk about assigning costs to products. So activity costs are going to be assigned to products by multiplying a predetermined activity rate by the usage of the activity, and this is going to be measured by activity drivers. Now, to calculate an activity rate, the practical capacity of each activity must be determined. To assign cost, the amount of each activity consumed by each product must also be known. Okay, here's how it's used: sustainability. I'm not going to read through these right now. You can do this on your own time. Okay, let's talk about activity-based customer costing and activity-based supplier costing. Okay, so activity-based systems originally became popular for their ability to improve product costing accuracy by tracing activity cost to the products that consume the activities. Activity-based costing has expanded into both upstream and downstream areas, meaning upstream before the production section, so meaning the research and development and the prototyping parts, etc. Downstream, this is going to be the after production, so more in your period costs with your marketing and your distribution and your customer service and so on and so forth. So once again, activity-based costing has moved beyond the product. It's went both upstream and downstream in nature. So that's good to point out. So by doing so, now we're able to do both customer costing and supplier costing because of how this system has both moved both upstream and downstream. So ABC is often used to more accurately determine the upstream cost of suppliers and the downstream cost of customers. Once again, we talked about this on the previous slide. By knowing these two types of costs, both your upstream and downstream cost of that of the customer and the supplier, obviously that could be really good information for the company, because it could really substantially improve a company's ability to become more profitable. So these are really good tools that a company has at their hands that they should use to really help the profitability of a company. Okay, let's talk about cumulative customer profitability. Okay, let's talk about this example. There's a high-tech producer of semiconductors. They implemented activity-based costing on customer costing, and by doing so, they discovered that 10% of its customers were actually responsible for about 90% of its overall profits. So once again, only 10% of its customers were responsible for producing 90% of its profits. They also discovered it was actually losing money on about 50% of its customers. So about half of their customers were actually costing this company money, as opposed to actually making it money. So it ultimately worked to convert its unprofitable customers into profitable ones, and invited those who would not provide the fair return to their business to just go ahead and just become a customer of that of another business. So in other words, they just were no longer interested in providing the customers the service that they needed, and makes sense because they were losing money on it. So as a consequence of doing so, this high tech company saw a major decrease in their sales. So huge decrease in actual sales, but their overall profit actually tripled. By looking at the next slide here, we can see um, the relationship between the actual customers and their contribution to a company's profitability overall. So let's just look here for just a second. The name of this is a well curve of cumulative customer profitability. So we see on the left the cumulative profits. On the right, we have cumulative customers here. And we can see here we start with the most profitable customers and move to those that are the least profitable customers. So obviously, by using this type of ABC costing system, these companies can discover which customers is going to be responsible for producing the most revenue for their company, and the ones that are not producing that much profitability. We can see here that once we get to about the 20% of cumulative customers, that's about the peak, between 20 and 30%, about the peak and the cumulative profits. And then from beyond that point, you can see here that it starts to decline. So we can see here on the cumulative customers for in this situation, probably about 28% is going to be your peak for the most cumulative profits within the company. So once again, that's just a nice little visual here of how the number of customers that a firm has, and how there can actually be a point to where you actually start losing money because of the amount of customers that you're actually servicing. So that gets us into activity-based customer costing. So customers are obviously going to be cost objects of fundamental interest. What's that mean? Pretty much customers, we have to know them, pretty much the nature of them, and what it's going to take to be able to satisfy them in the long haul, to be able to help determine really critical aspects of the company. So knowing how much it costs to service different customers obviously is vital information. Once again, because that knowing the expense of what it takes to service your customers obviously is going to go into the determination of what you sell your products for, or your services for. Because obviously you want to make sure you set it high enough to where you're covering your costs and to where you're making money. It's going to ultimately determine the mix of your customers. So what ultimate mix of customers that you're going to have. So what type of markets you're going to go after, what type of segments, and it's obviously going to help us improve the profitability of a company, because as we can see before, not necessarily more customers is better. Not always. The key is to find those good quality customers. And beyond these measures, because of the diversity of customers, then obviously we need multiple drivers to trace these costs more accurately. So customer costing versus product costing. So assigning the cost of customer service to customers is going to be done in the same manner that we do for the manufacturing costs to that of the product. So the same way we've been doing, assigning these costs to the products that we've been producing, the manufacturing costs, the way we've been assigning and allocating them to products beyond the direct labor and the direct materials. We're going to use the same allocating methods here for the customers and for the product. Customer-driven activities such as order entry, order picking, shipping, and handling, so on and so forth, are all going to be identified and listed in an activity dictionary. So once again, you remember the activity dictionary that we created based upon those interview questions that we had with those managers, trying to identify the activities and the characteristics of those activities. So once again, we're going to use this activity dictionary again to just trace this customer driven activities in the same way that we did based upon the operations of the company from the management's perspective. The cost of the resources consumed is then going to be assigned to the activities, and the cost of the activities is going to be ultimately assigned to the individual customers by using activity drivers. So once again, we're going to do the same thing here. It's all going to be tied down to this activity driver with that direct correlation between the activity, between the two activities that we're measuring. Knowing the cost of individual customers or customer types can ultimately be helpful in setting prices and determining the best customers. So now let's look at an example of how to actually calculate the activity-based customer costs. So it says here that Milan Company produces precision parts for 11 major buyers. Of the 11 customers, one accounts for about 50% of the sales, with the remaining 10 accounting for the rest of the sales. The 10 smaller customers purchase parts in roughly equal quantities. Orders placed by the smaller customers are about the same size. Data concerning Milan's customer activity is going to follow on the previous slide. Okay, so we can see here once again. Remember, we have a large customer that purchased half their overall sales, and then we had the 10 smaller customers that accounted for the same amount of activity of that of the larger customer. So we can see here if the 10 smaller had the same amount of volume as the large customer, then the units purchased from the two are going to be the same at $500,000. The orders placed, however, look at the significant difference between the 10 smaller customers and the large customers. There's only 2 orders placed for the large customer and 200 placed for the 10 smaller customers. On the number of sales calls, there was only 10 for the large customer, and there were 210 calls for the 10 smaller customers. Okay, next, manufacturing cost. Obviously, we're going to each be $3 million for each one because that's based upon the units that was purchased, or obviously the units produced that were ultimately purchased. Order filling costs allocated and the sales force cost allocated. And you can see here gives the explanation down here. This is allocated based on sales volume. So once again, sales volume was the same between both that of the large customer and the 10 smaller customers. So with allocating them based on sales volume, that's why these costs are going to be the same between the large customer and the 10 smaller customers in both the order filling and the sales force cost. Okay, and once again, this is because currently customer driven costs are assigned to customers based on units sold. Therefore, that is going to be our unit level driver. Okay, so once again, units sold, or in this case, units purchased, was our unit level driver to allocate the order filling and the sales force costs between that of the large and the 10 smaller customers. Okay, so with this data given right here, what they want us to do is to assign costs to customers using an ABC approach, the activity-based approach. Okay, so the appropriate drivers are orders placed and number of sales calls. So once again, we can see here the 404 over the 202. So once again, this is dealing with the orders placed. So we can see here the total orders placed between the large customer and the 10 smaller customers is 202, with 2 from the large, 200 from the 10 smaller ones. So there's our denominator, the 202. Okay, the 404,000. Okay, once again, orders placed, number of sales calls. That's orders placed, number of sales calls, 220. Orders placed, 202. Order filing cost, order filling cost, 202, 202. There's your 404. Sorry, I got those mixed up on accident. I lost where I was. So once again, we're based with the orders placed, number of sales calls, orders placed, 202. Filling cost, the 404. Once again, just want to show you where I messed up last time. 404 divided by 202. So that's going to give us $2,000 per order. Next, with the calls, number of sales calls, 220. Okay. Salesforce cost 220. It's the 220 over to 220, so that's 1,000 per call. So once again, we're just using this data to see how much it would cost for each order and each call, because we want to ultimately look at the difference between this part of the information here between the two, because everything else is constant or the same. Okay, so now that we have these, we want to take this information, and the customer driven cost can then be assigned to each group of customers in the following manner. So we can see here, once again, we'll just set up two little charts here: the large customer, the 10 smaller customers. So we can see the order filling costs right here. So 2,000 times 2. So once again, we have the order filling costs. It's 2,000 per order. So that's where the 2,000 is coming from here. The large customer, they only had 2 orders placed. So that's where you're getting the 2. So the $2,000, once again, 2,000 per order, what we found here, times 2 orders from the large customer, $4,000. Then once again, 2,000 from here, times the 200 for the 10 smaller, because remember the 10 smaller customers had 200 orders placed. Okay, that's $400,000. Next, for the Salesforce costs, we have 1,000. Remember, because it's $1,000 per call that we found right here. For the large customer, remember they only had 10 calls right here. So 1,000 times 10 for the large. For the 10 smaller customers, remember they had 210 calls right here. So that's where the 210 came from. 1,000 times 210 is 210,000. Then we just sum the two columns here. So 14,000, 610,000. So obviously we can see here how much the difference in just servicing these customers are, just based upon the amount of orders placed and the number of sales calls here. Pretty significant here. Okay. So once again, big difference based upon the number of customers. So you can see here by looking at that description there, that example, that more customers doesn't always necessarily mean more profit, more money. Okay, so the key is, once again, is to get really good quality customers, and not only just quality customers, but also really quality suppliers, because it's a whole system that just it's one big system that just ties together, and you want it to be one good smooth working system. So activity-based supplier costing. So now let's talk about some of the supplier costing. Activity-based costing often is used to more accurately determine the upstream cost and downstream cost. We've already talked about that, and obviously, once again, it says that this is vital information for improving a company's profitability. So once again, now we're just trying to look at these upstream costs now with the supplier, because we've already looked at the customers. Okay, so supplier costing. So assigning the cost of supplier-related activities to suppliers is going to follow the same pattern of activity-based costing, product and customer costing. So once again, same method, same song and dance here, nothing new, just for a different activity that we're tracing. Okay, so now we're just tracing the cost of that of the supplier as opposed to the product or the customer. Some examples of supplier-driven activities are purchasing, receiving, inspection of incoming components, reworking products due to defective supplier components, expediting products due to late deliveries of supplies. So expediting products means just speeding up the process of producing whatever good it is you're producing to make up for lost time for waiting on your materials. And then warranty work, and this is obviously due to defective supplier components. So once again, you can see here how all this stuff ties into wanting good quality suppliers as well. We don't want late deliveries, because then we have to expedite our products, which is more time, more planning, more bumps in the road. And then obviously the warranty work, which could be really start cutting into your overall profit throughout time by having to fix what should have been right from the first place, from that of your supplier's components being defective. Okay. The cost of the resources consumed is assigned to these activities, and then activity drivers assign the resulting activity cost to the individual suppliers. So you can see same pattern as we did before with the product costs and the customer cost. Now we're just applying it once again with the supplier costs. Then these costs are then added to the direct purchase costs. So once we figure out these additional supplier costs, we add them to the direct purchase costs. And then obviously by having the direct purchase cost and then these other incremental costs that we calculate to add on top of those direct purchase costs, that's going to enable these managers of these companies to be much more well informed on the decisions that they're making. So in turn, are going to make much better decisions. Okay, so let's talk about how a little example here of how to actually calculate activity-based supplier costs. Okay, so let's assume that a purchasing manager uses two suppliers. We have Murray Incorporated and Plata and Associates. Okay, so once again, these are going to be the source of two machine parts from these suppliers, Part A1 and Part B2. So once again, we're buying Part A1 and Part B2 from both of these suppliers right here. Consider two activities: repairing products under warranty and expediting products. Once again, repairing products under warranty is because of defective supplier parts. Expediting products is speeding the manufacturing process up to make up for lost time of waiting for products to get raw materials and your products to get from your suppliers to you to start the process. Okay, so repairing products occurs because of part failure, whatever, bought from suppliers. Expediting products occurs because suppliers are late in delivering needed parts. Activity costs, information, and other data needed for supplier costings follow. Activity costs caused by suppliers. So once again, failed parts or late delivery. That's this top part right here, activity costs caused by suppliers. So once again, these are the two things they told us we needed to consider. The two activities, repairing products and expediting products. So here's the cost with each of those activities they just gave us. Repairing products, we have a cost of $800,000. Expediting products, we have a cost of $200,000. Okay, the second step here with the supplier data, we can see here on the far left, we have the units purchase price, the units purchased, failed units, and late shipments. So we can see here that the failed units and the late shipments have a direct correlation with the activities up here in the cost. The failed units correlate with the repairing products. Late shipments correlates with the expediting products. Next, we can see the next four columns are just the two products that are being sold by each relative company. The first two columns is that of Part A1 and Part B2 sold by Murray Incorporated. The last two rows, row 3 and 4, is Part A1 and Part B2 being sold by Plata Associates. So using this data right here, let's determine the cost of each supplier by using activity-based costing, okay? So using the above data right up here in this chart, once again, what they want us to do, we need to use the activity rates for assigning cost to suppliers. So first thing they want to do is find the activity rate. So the repair rate, once again, 8,000 divided by 2,000 units. So let's talk about this, 8,000 units. 800,000 units. Repair products, there's the cost. All right, repair rate is the cost. And then the 2,000 units right here, we can see here is just the total units. Failed units, 1,600, 380, 1010. Okay, so the repair rate is going to be total cost given to us up here. Repairing products cost, 800,000. That's your numerator. Your denominator, the 2,000, is the total units. Notice that we're including all units, both parts A1 and part B2 from both companies, both Murray and Plata here, not just from one or the other. We're including them from both in order to get the overall repair rate, because it has to be that way because that's our two suppliers. So we're calculating it based upon our normal operations between the two suppliers. So once again, this repair rate is based upon, remember your denominator, that's based upon all the failed units for both from both different suppliers. Okay, so the expediting rate, once again, the cost is your numerator. 200,000 expediting products is the cost of 200,000. So that, once again, there's our numerator. And then the 100 right here, that's 60 plus the 40. That's just the late shipments. And you can see we did include all both products from both companies here. So all 4 items, as you can just see here, there were no late shipments from Plata. The only late shipments was from that of Murray Incorporated. So the 60 and 40, that's where that came from here. There's your denominator. So once again, there's your expediting rate and your repair rate based upon that data right here that we just went through. Okay, now that we have these rates here, and also the activity data, the total purchasing cost per unit of each component can be computed. So once again, we're just going to set up this little chart right here. We have Murray Inc. and Plata Associates, and we have each relative part A1 and part B2 for each of the companies. Next thing, we just want to do the purchase cost, and once again, we're just going to go right back to this data. Unit purchase price, you can see here for Murray 20 and 52, 20, 52, 24.56 here relates to this 24.56. Okay, so there's this right here, and then the costs here. Once again, this is just the actual cost per unit: 80, 40, 10, 10. 80, 40, 10, 10, and obviously we just multiply these for each part that it belongs to for each company. Same thing for repairing products, the 400. Okay, repairing products. Oops, sorry. So once again, repairing products, this 400 right here is your repair rate, $400 per unit. So that's the 400 right here. And then the products, this actually ties to the failed units, remember? So that's where you can see where we get this data from. Once again, that's where your data came from. Okay, and then obviously we follow, just multiply it and plug it where it belongs in each relative column. In the expediting products, the 2,000 came from our expediting rate that we found right here, 2,000 per late shipment. And then the 60 and the 40, once again, just came from the late shipments right here. In this case, only Murray was late. And once again, you just multiply it out. Once you have your purchase cost, your repairing products cost, and your expediting products cost, then we just obviously add all these together. That'll give us our total cost. From there, we just divide it by the number of units, and that'll give us our total unit cost, okay? So obviously, if all costs are going to be considered between these two companies, then obviously it's a pretty clear choice between the two. Plata Associates is obviously going to be the better supplier. They're producing a higher quality product that they're providing to us, and they have more on time deliveries as well. So that's definitely going to be the better of the two suppliers between the two would be Plata. Okay, I'm not going to get into how it's used at a small consulting firm, so these next 5 slides you can read on your own. Okay, let's talk real quick about process value analysis. So this is going to be fundamental to activity-based management, okay? So process value analysis is really important. Activity-based management is it's just going to be a system-wide integrated approach, which pretty much just focuses management's attention on activities. Basically, the objective of the activity-based management is to improve the customer value and profit at the same time by achieving or by providing the value. The process value analysis focuses on cost reduction as opposed to the cost assignment, and emphasizes the maximization of system-wide performance, okay? So once again, this is process value analysis. We're concerned with 3 main parts: driver analysis, which is the why whatever's going on. The next being the activity analysis. The activity analysis is what's going on, And then the performance measurement is how well did you do with the overall process. Okay, we'll start with the driver analysis. So this is the search for the root causes. Managing the activities is going to require an understanding of what causes activity costs. So every activity is going to have an input and an output, right? So these activity inputs are going to be resources that are consumed by the activity and producing the output. The activity output is going to be the result of a product of an activity. Okay, an activity output measure is the number of times the activity is going to be performed, and it is the quantifiable measure of the output. The driver analysis is going to be the effort expended to identify those factors that are going to be the root causes of each of the activity costs. Okay, activity analysis, identifying and assessing value content. So the heart of process value analysis is going to be activity analysis. So once again, the activity analysis is just the process of identifying, describing, and evaluating the activities that an organization performs. So once again, just analyzing the activities within an organization. Activity analysis is going to produce different outcomes, mainly 4 different outcomes. So these outcomes are going to be what activities were actually done, how many people actually perform these activities, the amount of resources and the amount of time that it was required to perform these actual activities, and then an overall assessment of the value of the activities to the overall organization. And so obviously by doing this assessment of the value of the activities to the organization, at this point is where these managers are going to have to make a decision of whether these activities continue or whether they're going to be discontinued, because ultimately if they're not adding value, then they need to be discontinued, because the ultimate goal of a business is to make money. So therefore activities can be either classified as a value-added activity or a non-value added activity. Start with value-added activities. So these are going to be the activities that are necessary to pretty much remain in business, okay? So if the activity is necessary to remain in business, then this is known as a value-added activity. Some of these activities are going to be value-added, and they're going to be done so because of being mandated by law. The two main ones to be concerned with is the activities required by the SEC, which is primarily concerned with internal control over financial reporting, and then that of the IRS, and obviously that's going to be concerned with tax implications or tax liabilities. Now, the remaining activities in the firm are going to be discretionary. Pretty much a discretionary activity is going to be anything classified as a value added, provided it simultaneously satisfies all the following conditions, okay? So once again, a discretionary activity is going to be classified as value added if it provides, if it produces a state of change within the organization, okay? If the change of state was not achievable by preceding activities, so meaning that we could not have achieved the change that was achieved through this discretionary activity if we would have not undertaken that discretionary activity. The activity is going to enable other activities to be performed, so meaning it pretty much made it better. So now we by taking on this discretionary activity, now we can perform a whole other host of activities, okay? Now let's talk about non-value added activities. All activities other than those that are absolutely essential to remain in business, and therefore considered unnecessary, these are all going to be referred to as non-value added activities. These can be identified by its failure to satisfy any one of the 3 previous defining conditions for adding value. So once again, we're talking about these 3 conditions right here. They fail to meet any of these 3 conditions. A good example is the inspection of a machine or a process is not a value added because it's a state detection activity and not a state changing activity. So they're just detecting the state of the activity to make sure it's up to par. More on non-value added activities, the costs that are caused either by non-value added activities or the inefficient performance of value added activities. So once again, for non-value added activities, the non-value added cost is pretty much just the cost of the activity itself. So if it's a non-value added activity and it doesn't add anything to it, doesn't meet any of those three thresholds, then the activity itself is the overall cost of the non-value added activity. Okay, for inefficient value added activities, so then the activity cost is going to have to be broken into components that it did add value and the components that it did not add value. So once again, this relates to the inefficient performance of value added activities, meaning wasted time and effort and money on an activity that is adding value to a company. So the value added component is the waste free component of the value added activity, and therefore the value added standard. So let's talk about some examples of non-value added activities. Okay, so in terms of manufacturing or the manufacturing operations, the following activities are usually going to be termed or cited as being wasteful and unnecessary. So these would be non-value added activities once again. Scheduling. I think we all know what scheduling is: activity that uses time and resources to determine when different products have access to processes and how much will be produced. So the scheduling of activities, scheduling of events or meetings, whatever it might be. Moving, this is just moving goods from one station to another, one department to another, one geographic location to another, whatever it might be. So once again, this is dealing with your raw materials, your work in process, and finished goods from one place to another. Waiting, so this is an activity in which raw materials or work in process use time and resources by waiting on the next process. So once again, that's why we want to eliminate these delays, whether it be from the supplier, whether it be on shipping it to the customer, or whether it be within the actual manufacturing process itself. We don't want to just wait and have just idle time. That's lost money. Inspecting, this is an activity in which time and resources are spent ensuring that the product meets specifications, making sure that an item's up to code or whatever regulations that it has to be up to date for. This could be for federal purposes, with the government. This could be for insurance purposes, for the safety of working conditions for employees, stuff of that sort. Storing, this is an activity that uses time and resources while a good or raw material is held in inventory. So once again, this is the process of storing our inventories. And these are all examples of non-value added activities. Okay, next, activity management, reducing costs in 4 major ways. The activity elimination is going to focus on non-value added activities. So maybe we can eliminate a step in one of these processes down the assembly line by reducing having to go from one end of the room to the other every time that the process is performed. So stuff like that, activity elimination. Activity selection, obviously this involves choosing among different sets of activities and choosing the one that is the best out of the competing strategies. Activity reduction decreases the time and resources required by an activity, so cutting down on the direct labor and indirect materials of an activity. Activity sharing, so this is increasing the efficiency of necessary activities by using economies of scale. So maybe, like for example, we use the computers, and that the clerks use the computers for 3 different types of things. So that's a means of activity sharing. So being able to have more activities going on and within that department at once, as opposed to just one. Okay, how it's used at Kicker. I'm not going to go through these. You can go through these 3 slides on your own when you get a chance. Okay, assessing non-value added costs. These are caused either by non-value added activities or even value added activities that are not performed effectively or efficiently. Okay. In order to determine these non-value added costs, it has to be followed by a root cause analysis, and then by the selection of an appropriate or of an approach to reduce the waste found in the actual activity itself. Okay, so let's talk about how to assess non-value added activity costs. So consider the following 2 activities: performing warranty work, and the cost of which is $120,000. The warranty cost of the most efficient competitor is $20,000. The second of the 2 activities is purchasing components. The cost is $200,000, 10,000 purchase orders. Once again, a benchmark study revealed that the most efficient level will use 5,000 purchase orders and until a cost of $100,000, so half of what was actually going on. So what's required for this problem is to determine the non-value added cost of each activity. Okay, so out of the two activities, performing warranty work and purchasing components, we want to see what the non-value added cost of each activity is. So the solution would be to determine the value content of each activity, and then to determine whether the activity is a non-value added or value added. So by looking at the warranty work, remember it said that the warranty work was a cost of $120,000, right? And they benchmarked it to the most efficient competitor of being $20,000. Well, performing warranty work is non-value added, okay? This is going to be done to correct something that wasn't done right in the first place. So your manufacturer or your supplier sent you a defective component or a defective product, right? So this is something that should have been right from the beginning, right? So the non-value added cost of performing warranty work is going to be the total cost of the $120,000, which is the cost of the warranty work to the firm. Okay. Benchmarking in this case, in terms of warranty work, is really immaterial. Or is really not material. It's material, but it's really doesn't even matter because it's no bearing on the analysis because the warranty works are for defective products. Purchasing components is going to be necessary so that materials are going to be available to produce products, and therefore the purchasing components has to be a value-added activity. The activity is not going to be performed efficiently, then obviously there could be a non-value-added component that goes into this. Obviously, in the case of this problem, that was the case. We could see by benchmarking that we originally were spending $200,000 for 10,000 purchase orders, where the benchmark study said it should be 5,000 purchase orders with a cost of $100,000. So once again, remember the purchasing component is a value-added activity, but it being ineffectively or not efficiently ran, right? Because of the benchmark study. So the cost per purchase order is going to be $20. So right here we're using the benchmark study numbers. If you recall that 100,000, your numerator, your denominator 5,000. So you see here that we're using the benchmark study. Benchmark study reveals most efficient levels 5,000 at a cost of 100,000. 100,000 divided by 5,000. There's our purchase order. Cost per purchase order is $20. So therefore, the non-value added cost is going to be calculated as the actual quantity minus the value added quantity times the cost per purchase order. Okay, so actual quantity, once again, we can see here is 10,000. We get it right here. Sorry. Actual quantity, 10,000 purchase orders, minus the value added quantity, which is 5,000. That's the 5,000 value added, most efficient level. Okay, and we want to multiply that by the cost per purchase order, okay, which in this case, $20. It was right above it. So what we found in the first step, $20 cost per purchase order. Remember, that was with the benchmark, what was the most effective numbers right here that we used for this purchase order, cost per purchase order. So once again, actual quantity, the amount the company's actually using, minus the value added quantity, which is the benchmarking one, multiplied by the cost per purchase order based upon the benchmarking data. Okay, or simply the 200,000 minus 100,000, which is the difference between their actual cost and the actual cost right here. So the difference between these two is going to be the non-value added cost. That's for the purchasing component, because remember the purchasing stuff is a value added component. Performing warranty cost is not, so the full cost is. Okay, activity performance measurement. This is assessing how well activities and processes are being performed And this is going to also be fundamental to management's efforts to improve profitability. Activity performance measures are going to exist in both financial and non-financial forms. Measures of activity performance center on three major dimensions: efficiency, which is the relationship of activity inputs to activity outputs; time, the time that's required to actually perform these activities; and the quality, which is doing the activity right the first time it is performed. So that leads us to cycle time and velocity. Cycle time and velocity are two operational measures of time-based performance that ultimately measure the time it takes for a firm to respond to such things such as customer orders, customer complaints, and the development of new products. The objective is to reduce cycle time, therefore increasing velocity, and result improve response time and make the firm more competitive. Okay, cycle time measures how long it takes to produce an output from start to finish. So the formula for cycle time is time divided by units produced. So time's your numerator, units produced is your denominator. In a manufacturing process, cycle time is the length of time that it takes to produce a unit of output from the time raw materials are received. So at the point we receive it from our suppliers, and until the good is actually delivered to finished goods inventory. So from the time we receive the raw materials until the time that we place it into inventory. That's the cycle time divided by units produced. Lastly, next, velocity is the number of units of output that can be produced in a given period of time. Velocity is just going to be units produced over time. So if you notice here, velocity is the reciprocal of cycle time, meaning it's just a complete inverse relationship, right? So it's the reciprocal of cycle time. Remember, cycle time is time over units produced. Velocity is units produced over time. So velocity is the reciprocal of cycle time. Let's assume that Frost Company takes 10,000 hours to produce 20,000 units of a product. What is the velocity in hours? What is the cycle time in hours? And what is the cycle time in minutes? So we can use these formulas right here, once again, for cycle time and velocity to find what's required here. So velocity is going to be the 20,000 divided by 10,000. Once again, the formula for velocity is units produced over the time. Units produced was 20,000 units. The time it took was 10,000 hours. So velocity is 20,000 units divided by 10,000 hours. So that leaves us with 2 units per hour. Cycle time, remember that is time over units produced. So it's 10,000 hours divided by 20,000 units. So that's a half an hour. There's time in hours. Okay. Next, 30 minutes, 10,000. There's 60 minutes. Okay. In each hour, 10,000 hours, 60 minutes in each hour. So 10 times 60 divided by 20,000 by the units produced is 30 minutes. Okay, so you can express this in hours or minutes. Okay, and you can do the velocity in hours. So that's how you calculate the cycle time and velocity. That's it for this lecture for chapter 5. We'll be going over problems in class and on Monday related to this lecture. So I want everyone to watch this lecture prior to coming to class. Thank you for your time, and I will see everyone in class tomorrow.